Hey everybody, hope you're all doing good and hope you're all safe. A very good evening to everybody and welcome to Oliveboard's 100 most important questions for finance section. So we have started this last week and we are continuing this important question series for finance section, and we have already done the same for the management section too. If you have not watched the videos related to it, you can go to the playlist in the Oliveboard channel and you will be finding all the videos that we have been covering till now. So let's begin the class very quickly, but I want to know from every one of you if my voice is audible and clear so that we don't waste any time before moving ahead. So, am I audible, everyone? And are we good to begin? Hello, Tanu. Hello, Mrunal. Yes, thank you so much for giving the confirmation. And as always, I'm going to begin the class with the quote for the day. So, today's quote is: to improve is to change, to be perfect is to change often, told by Winston Churchill, right? And I think this is very, very relevant, especially even for the competitive examination aspirants, because we try to incorporate one strategy. Sometimes it might work, sometimes it might not work, and we might be giving the exam probably more than once. And what happens is that we need to constantly improve and perfect our uh, strategies, right? And for that, we need to change. So please do not shy away from changing things, because only by changing we can improve and we can become perfect, right? So with this, I would like to begin the class today with the first question: which of the following is an expansionary monetary policy? A, it tries to reduce the inflationary pressures in the economy. B, it is a policy generally followed during the recession times. C, it has neutral effect on the level of economic activity. D, it is not a sustainable policy and leads to budgetary deficits. E, B, and D. So, what is the answer for this question? The answer is option E, B, and D. So both the statement B and D are correct here. So an expansionary monetary policy is a policy generally followed during the recession times, and also it is not a sustainable policy because it's going to lead to budgetary deficit. But the other two statements, if you take the first statement, it tries to reduce the inflationary pressures in the economy. This is talking about the contractionary monetary policy. It's not an expansionary monetary policy. And the third statement, it has a neutral effect on the level of economic activity. It is neither expansionary nor contractionary, but it is a neutral monetary policy stand, right? So let's understand what is a monetary policy in the first place. Monetary policy, on the whole, as we all can understand, deals with money. So how much money is in the economy and how we are going to regulate the amount of money in the market is what monetary policy on the whole is trying to do. And you can understand that the main role played in the monetary policy is going to be with the central banks of the respective countries. So the term monetary policy generally refers to the action taken by the central banks to affect the monetary magnitudes or other financial conditions. And the money supply is going to definitely have an influence in the price levels too. So whenever monetary policy changes are happening, you will see that the price levels in the economy is also going to be changing, and also it's going to affect the inflation and the deflation in the economy. So these are all the effects that a monetary policy is going to provide us, right? So basically there are mainly two types of monetary policy. One is expansionary one and other is the contractionary one. As we have already seen, an expansionary monetary policy is a policy where the central banks of the economies generally try to stimulate the economies, and this is generally undertaken during recessions, because there will be a need for stimulating it, because the economy is no more responding by itself. So there is a necessity by the central banks to intervene here, and what they're going to do is to stimulate. And how do they do that? They are going to increase the money supply, and also for the same they'll sometimes also lower the interest rates. So this is what is generally followed during an expansionary monetary policy. And what are the side effects of what are the effects of an expansionary monetary policy? As we have all understood, the cause is we are trying to address the recession. So the effects are going to be, it's going to lower the unemployment rate and thereby increase the growth rate, right? So these are the two important fallouts of the expansionary monetary policy. And here we have to remember that there are other names for expansionary monetary policy, which is also called as easy money policy or also a loose money policy, right? Because we are having lower interest rates, and lower interest rates mean that there's more money supply. Exactly, and that is the reason it's going to be called as a easy money or a loose money policy. So what is contractionary money policy? It's going to quite oppositely work with respect to the expansionary monetary policy. In contractionary monetary policy, you will see that the main objective is to bring down the inflation rate and thereby decrease the growth rate of the money supply, right? The main objective of a contractionary monetary policy is to fight the inflation. Whenever the economy is having higher inflation, governments over the world are going to come up with this contractionary monetary policy where they are going to try to decrease the money supply. And how will they do that? They are going to do the converse. That is, they are going to increase the interest rates. And when the interest rates are increasing, the fallout is definitely going to be a decrease in the money supply, right? So this is the basic difference between what is an expansionary one and a contractionary monetary policy. Next question: which of the following bills allows government to withdraw funds from the consolidated fund of India? A, finance bill; B, money bill; C, appropriation bill; D, vote on account; E, none of the above. The answer is C, appropriation bill. So appropriation bill is the bill that allows the government to withdraw funds from the consolidated fund of India. So what is an appropriation bill? According to the Indian Constitution, it falls under the Article 114, and after passing the demands under the Article 13 of the Constitution, the next step in the budgetary process is going for the appropriation, passing of the appropriation bill in the Lok Sabha. And this will make sure that the money can be used from the consolidated fund of India. Without passing the appropriation bill, it is not possible for the governments to use the money or the money allocated in the budget, right? So this is a very, very important thing. And the article that does talk about the appropriation bill is Article 114. So what is the basic difference between other two options that we have seen here? We spoke about money bill and also finance bill. And I think money bill is very, very clear. In Indian Constitution, money bill falls under the Article 110, which is also called as the budget, right? So we know what all provisions comes under the budget. And so what matters that money bill is going to be dealing with, it's very clear, right? So basically money bill is going to talk about the budget in clarity, and it has Article 110 granted in the Constitution. And we have another types of bills which are called as financial bills, and these are again subdivided into two categories. One is category A and category B, and both of them are listed under Article 117 of the Indian Constitution, right? Both financial bills of type A and type B are falling under the financial Article 117, and here mostly the financial bill is going to deal with whatever provisions that are not exclusively dealt in the money bill, right? So these are going to talk about taxation of the expenditure, and it's also going to contain some other provisions which are not discussed in the money bill, right? So there is some underlying difference between finance and the money bill. That is what we have to take the reference from this. So you can understand that the finance bill is a superset, whereas you will have the money bill and these different types of finance bill as a subsets of the overall type of the finance bill. Next question: which of the following are not part of the revenue receipts? A, tax revenue; B, recovery of loans and advances; C, profits and dividends; D, government receives financial help from the foreign governments and the international organization; E, all of the above. So which will not fall under the part of the revenue receipts? The answer is option B. Recovery of loans and advances will not fall under the category of revenue receipts. So they fall under the category of capital receipts, not revenue receipts. So all other things, the all other components that we have in the options here, they are under the revenue receipts. The tax revenue, the profits and the dividends, whatever financial help the government is going to get from the foreign governments or from any other international organization, these are all going to be falling under the category of the revenue receipts. So what is the answer here, which is not part of it? It is recovery of loans and advances, right? But here you have to note that interest paid on the loans will be part of the revenue receipts. Interest being received on any of the loan that is given by the government. So consider there is our government here and it is advancing a loan to probably anybody, And what happens whenever the government is going to get back the loan from these bodies, these will be accounted in the capital receipt. But whatever interest on the loan, that is going to come under the revenue receipts of the government, right? This is the simple difference that we have to remember here. So as we all know that the budgetary receipts of the government of India is classified into two main types. One is the revenue and the other the capital receipts. So in the revenue receipts, there is two major classification. One is the tax revenue. We have the non-tax revenue components. So in the revenue receipts, there are two major components, one being the tax and other coming from the non-tax sources. In the tax, again, we have two classification. One is the direct tax that we pay and also the indirect tax. So I'm sure everyone knows what is the direct tax. Direct taxes are those taxes where the liability to pay and the burden of the tax are going to fall on the same person. But it is not the case in case of the indirect tax, where you see that the liability to pay and the burden are going to be on the different persons. For example, we can take the case of the sales tax, where the customers are going to pay the indirect tax, pay the sales tax, but it is going to be taken by the salesperson and it will be paid to the government of India, right? So here the burden is falling on the customers, but the liability to pay to the government is on the shopkeepers, right? So that is how an indirect tax works. But whereas a direct tax, like the income tax or the corporate tax, the liability and the burden is going to be on the single person. And you know that all the different types of direct taxes, all the different types of the indirect taxes will be categorized as this part of the tax revenue. So what are all those heads which are going to come as a part of the non-tax revenue? You have to remember that the interest receipts, as I told, whenever government of India is going to advance any loans for any other government or any other bodies, the interest that these bodies have to pay for these loans will be accounted in the revenue receipts category. Along with this, the profits and the dividend of the PSUs or the public sector organizations will be under the non-tax revenue category, and the fees and the fines, any external grants received from the foreign governments, all of these are going to be falling again under the non-tax revenue component of the revenue receipts. And what are all going to be there in the capital receipts? The loan that the government of India has given, and when it is recovered, it is going to be following under the part of the capital receipts. And along with that, you will see the disinvestment, any big borrowings that the government is going to take, and also the provident funds. All of these categories will fall under the capital receipts of the budget, government budgeting. Next question, which of the following are part of the capital expenditure? A, salary paid to the army officer. B, interest paid on national debt. C, government expenditure on investment of land, building equipment and machinery. D, central assistance for states and UTs. E, C and D. The answer for this question is very simple, and it is E, both C and D. So if you see salary paid to the army officer, it is going to be under the revenue expenditure category. The interest paid on the national debt, it is also under the revenue receipt. It is also on the revenue expenditure. Whenever it's government of India is going to receive the interest from any other government, it is under the revenue receipt. Whenever it is going to pay some interest to the other organization, it will be under the revenue expenditure category. But investment or expenditure on land, building, equipment and machinery will fall under the category of the capital. And also the assistance that the center is going to give for the state and the union territories will also fall under the category of the capital expenditure, right? So C and D is the correct answer here. Let's see the quick classification of revenue and the capital components of expenditure too. So revenue expenditure components mainly deal with those expenditure which neither create assets nor reduces the liabilities, right? It's only in one way. There is no two-way direction in the revenue expenditure. But whereas capital expenditure is a two-way expenditure. That means when you're spending some amount for the capital expenditure, it is going to generate some kind of return after few years. So it is a two-way process, right? And here the expenditures are going to create assets, or either they're going to reduce the liabilities. So what all fall under the category of revenue expenditure? One, payment of interest. Two, payment of salaries and pensions. So it's only one way. Payment of interest is one way. Grants and subsidies that the government is going to give to the foreign governments or any other bodies. So grant is also going to be one directional, right? And also, for example, if Nepal is being flooded, what happens? Government of India giving some grant to Nepal is a one-way direction. It's coming without any expectation. So it is going to be under the revenue expenditure component. And then we have subsidies, which is also unidirectional. Then we have education, health, and defense services. So all the defense services will be under the revenue expenditure category. But here you also have to remember that any equipment for the defense category, when you're purchasing, it will be falling under the category of capital expenditure. So defense equipment purchase will be under the capital expenditure component, but defense services will fall under the category of revenue expenditure. So other than this, as you can see, construction of roads, bridges and buildings, purchase of land and machinery, investments in shares, loans to the states and the foreign government, and repayment of any loans. These are all going to be under the category of the capital expenditure. Next question, which of the following is the leading deficit indicator and also the best one to measure the health of the budget in the Indian context? A, monetary deficit, B, effective revenue deficit, C, revenue deficit, D, fiscal deficit, and E, primary deficit. I think it is a very straightforward question, and the answer here is D, fiscal deficit. So it is the most commonly used indicator to talk about the performance of the budget or the performance of the economy. And this is the main index that we try to target. It is not E, but it is fiscal deficit, right? D. So let's understand the basic difference between what is fiscal deficit, what is primary deficit, revenue, effective revenue deficits, and everything. So fiscal deficit is nothing but it is just the difference between government's total expenditure and the total receipts. So this is what is fiscal deficit. But with respect to the total receipts, it is not going to take into account the borrowing. When you exclude borrowing from the total receipts, and when you are going to subtract the government total expenditure and the total receipts, then it is going to be called as the fiscal deficit, right? And what is revenue deficit? By the name of it, we can understand that it is revenue expenditure minus revenue receipts. Whatever expenditure we are going to get from the revenue side, when we are subtracting it from the revenue receipts, we are going to get the deficit, revenue deficit. And what is effective revenue deficit? So this is a new term that was introduced from 2003, and you will see that effective revenue deficit is nothing but revenue deficit minus grants that are given for creation of capital assets. So whenever you're trying to exclude or subtract these grants that the governments are going to give for the creation of capital assets, we will be targeting the effective revenue deficit. Yes, Shivangi, thank you so much. It is 2013. So whenever you are subtracting grants for the creation of capital assets from the revenue deficit, it is called as effective revenue deficit. So this is a better indicator rather than the revenue deficits. And that is why we have come up with this concept of 2013. And what is a primary deficit? It is nothing but the amount of the money that the government requires to borrow. So it is going to say borrowing minus interest payments. So when you're trying to exclude the interest payments from the borrowings that the government is going to take, it is going to talk about the primary deficit, because we are not taking into account the interest that we have been paying for all the past years or the present years. We are only primarily talking about what we have been borrowing, and that is the reason it is called as a primary deficit, right? So these are all the components as we have been seeing here. Again, reiterating the same. First is let's understand what is the gross fiscal deficit, which is having all the five. Here it includes net interest payments, it includes revenue expenditure, and also revenue expenditure for the creation of capital assets, and it also includes non-debt creating capital expenditure and net domestic lending. All these things will be accounted in the gross. But when you are subtracting net domestic lending from the gross fiscal deficit, you get the net fiscal deficit. A plus B plus C plus D, right? And what is revenue deficit here? Very simple, which includes both B plus C. That is, it is going to include revenue, it is going to include B and also C, because here revenue expenditure for the creation of capital assets is also going to be taken into account. But when you talk about the effective revenue deficits, we are not going to take into account the creation of the capital assets. We are going to subtract the capital assets or the loans advanced for the creation of the capital from the revenue deficits, and that will be the effective revenue deficit, right? So next question, government spending using up the financial and other resources that would otherwise be used by private enterprise is called as dash. A, crowding out effect, B, deficit financing, C, Keynesian effect, D, loanable funds, and E, none of the above. The answer for this question is again very simple. If you're reading the statement correctly, the question correctly, I think you can definitely answer this. Government spending using up the financial and other resources that would otherwise be used by the private enterprise. What is it called? A, crowding out effect. Very good job, Ravi Kiran. Yes. It is nothing but the crowding out effect. And what is it? So let's understand what is crowding out here. It refers to the concept of increased government spending for which it is going to go for different sources of borrowing. And when government, so we have some institutions where governments and also private sector are going to borrow, right? So basically, you have some financial institutions, be it banks or any other financial institutions, from where governments and also the private sector. So from the foreign commercial companies, from the foreign companies, from the banks, from these kind of financial institutions, government and the private are going to borrow. So when government is using up most of the resources and it's borrowing most of them from the banks, what is going to happen? What is the lending capacity of the banks going to be then? It is going to definitely reduce. So it is going to obviously decrease the funds that can be possibly used by the private. So in turn, it's going to reduce the private spending. So this is called as crowding out effect, where you will see that the increase in the government spending necessitates more borrowing and in turn reducing the private spending. And you will see in such a kind of scenario, the lion's share of all the fund or the resources are going to be diverted towards the government. And this is also definitely going to impact the interest rate in the economy, right? And we have also here seen a term called as deficit financing, and this is one very common term that we read with respect to the monetary policy. What is deficit financing? Whenever the expenditure of the government is going to exceed its revenue that it receives, then what does government have to do? See, it is the same thing whether it's going to be a government or for a individual person. Whenever our expenditure is going to exceed our revenue, we have to find some ways of fixing this gap. And when governments do that, it is called as deficit financing. When government tries to fix this gap, one of the ways that it can resort to is deficit financing. So the temporary arrangement of funds through various methods is known as deficit financing. What are the possible methods that the government can use for deficit financing? One, it can go for printing new currency notes, which is not commonly practiced because it might spiral up inflation in a really big way. But this is also one of the ways. Two, it can borrow from the internal sources like the RBI, from the general public, from by issuing the treasury bills or the government's bonds. And the third way is it can borrow from the external sources, like borrowing from the developed countries or international economic institutions, be it World Bank, IMF, ADB, etc. Right? So you have to remember here that printing of the new currency notes is the least preferred method in the deficit financing, as it spirals up the inflation. And also, when deficit financing is going to be resorted more commonly, it is not a good thing to do, as we already saw that it's going to increase the amount of money supply in the economy, and naturally it's going to spiral up the inflation. Next question: which of the following statements are correct with respect to the medium term fiscal policy statement? One, it is a statutory document which sets out 3-year rolling targets for the fiscal indicator. Two, it's an assessment of sustainability relating to the balance between the revenue receipts and the revenue expenditure and the use of capital receipts, including market borrowings for generation of productive assets. Three, it includes 3 fiscal indicators in relation to the GDP at market prices. What is the answer here? It is option A. It does not include 3 fiscal indicators, as some of you have already given me answers. Yes, it uses 4 fiscal indicators, but the other two statements are correct here. So medium term fiscal policy statement is a statutory document because it finds its place in FRBM Act. And whenever anything is backed by an act, we call it as a statutory document, right? So here it is under the FRBM Act of 2003, medium term fiscal policy statement has been introduced, and what it does is it sets 3-year rolling target for various fiscal indicators, but they are not 3 in number. We have 4 fiscal indicators where we give the 3-year rolling targets, right? So what are these 4 indicators? One is revenue deficit, to GDP, then we talk about fiscal deficit, then we talk about tax to GDP ratio, and fourth, we talk about the total outstanding debt at the end of the year. So these are the four indexes that the medium term fiscal policy statement gives targets, right? And you have to remember how many years it's going to be there. It's for a 3-year rolling target. And from the budget 2018, our finance minister Arun Jaitley had done away with the revenue deficit as a part of the fiscal consolidation roadmap. So, more than giving emphasis on the revenue deficit targeting, we have been moving towards the debt, overall debt targeting, which includes central government and the general government debt, right? Which is more accurate indicator of the fiscal balance and the fiscal trajectory. Next question. The N.K. Singh led panel on fiscal responsibility has suggested overall public debt to GDP ratio of how much percent by the year 2022-2023. So we have to even remember the year by which we are aiming this. So the question can be either way. Yes, simple question. It is 60%. And remember the year also. So the overall public debt to GDP ratio is aimed to be at 60% according to the NK Singh panel on the FRBM Act. And the year by which they aim to achieve it is 2022-2023. So we have to know some of the important suggestions that were made by the NK Singh panel to the FRBM Act. It was set up, this committee was set up in the year 2016 and it has set three main targets. So when this committee was formed, the debt, the overall debt of the government of India was at 70%. So what it did, it was mainly aiming to bring this down to 60%. Overall government debt, the center and the states including, to reduce it to 60%, and a 40% limit for the center and a 20% limit for the states. And it also set a fiscal deficit target that it should reach 3% of GDP in years up to March 31st, 2020, and also bring it down to 2.8% in 2021 and 2.5% by 2023. But this was not possible because of the COVID effect, right? We have not been able to meet our uh, targets that we have been set for the fiscal deficit. And what is the latest provisions of the FRBM Act? We aim now to limit the fiscal deficit to 3% of the GDP by the March 31st, 2021. Right? Next question, which of the following statements regarding the escape clause of FRBM Act 2018 is incorrect? A. This terminology was innovated by NK Singh Committee on FRBM. B. The escape clauses can be invoked by the states after formal consultations and advice of the Fiscal Council. C. It gives a clear commitment to return to the original fiscal target in the coming fiscal year. D. A and B, E, all of the above. So what is the answer for this question? It is asking for the incorrect statement, right? If it had asked for the correct statement, the answer would have been D, A, and B. But since it's asking for the incorrect statement, the correct answer here is B. The escape clauses can be invoked by the state. This is incorrect. So the escape clauses will be invoked only by the center, not by the states. So the power is going to lie with the center to invoke escape clauses after formal consultations and advice from the Fiscal Council, which is also one of the body which was proposed by the NK Singh panel. So escape clause was introduced in the FRBM Act after the NK Singh committee recommendations in the year 2017. And what is this escape clause going to do? It's going to give a flexibility for the government to, with respect to meeting its fiscal deficit targets. That is the main aim, right? So sometimes we are not able to meet our fiscal deficit targets, and it gives the situations where government can take that flexibility, right? And that is what has been mentioned. And this happened because in 2017 also the government has fallen short of its fiscal deficit target, where CAG has then raised the issue with respect to differing the targets. That's when FRBM Act has been amended, and it included a new section under the section 4. So you have to remember escape clause in the FRBM Act is under the section 4. Sometimes these kind of questions can also be asked in phase 2 of the examination, and this clause allows the governments to relax the fiscal deficit target for up to 50 basis points. So remember this. What is the flexibility that is given? It can relax, it can have a flexibility of not meeting the fiscal deficit targets for up to 50 basis point or 0.5%. Right? And also, you have to remember there are certain situations, as I told, not in every situation this flexibility will be given, but there are some situations like national security, be it national calamity or war. Sometimes, like when the government is undertaking structural reforms or collapse of agriculture, all these situations can be taken as exceptionary situations or the grounds under which the escape clause can be invoked, right? And that is exactly the same reason even in 2020, Nirmala Sitaraman used the escape clause provided under the FRBM Act to allow the relaxation of the target. So it has revised the fiscal deficit target for the current year to 3.8% and for the coming year to 3.5%. Yes. So the last question for the day is this: which of the following means being conservative when estimating your revenues but accounting for the unforeseen when estimating your expenditure? A very commonsensical question. I don't think we need economics also going into it. So very simple question, and the answer is A, fiscal prudence. I'm extremely sorry again. So the correct answer is not E. It is fiscal prudence, right? Please mark this correctly. I don't want to confuse any one of you. I am making it clear here that what is this statement talking about? It is talking about fiscal prudence. Fiscal prudence means being conservative when estimating your revenues, but accounting for the unforeseen when estimating your expenditure, so that you are going to be in a positive zone. That's what we will be doing whenever we have to be fiscally prudent for the individual also, right? We try to reduce our revenues. Do not put all those sources of revenues which do not have 100% probability of getting it, and also account those expenditure with which can come unforeseen with, so that we are in a positive footing with respect to our finances, right? And the term was talking about fiscal prudence, which means the same as I have been telling you now. And what is fiscal federalism? It is nothing but it is concerned with the understanding of which functions and instruments are best centralized and which has to be going down to the decentralized levels. That means which taxes must be levied by the center, which taxes must be levied by the states, and which taxes or the finances must be looked upon by the local governments or the panchayats and the municipalities. So how we have to distribute our taxes, our revenues and expenditure is what is fiscal federalism going to talk about. Right, we are done with the 10 questions of the day. Thank you so much for joining this class. And I want everyone to make a note of the same, that Oliveboard has an exclusive SEBI Grade A package which will help you cover all the pillars of the examination preparation. We help you prepare through the Learn module, where you'll be getting the detailed study notes and also video lessons. And in the practice module, you will have subject-wise mini mock tests and also have full mock tests, full-length mock tests. You will also have the revised module, wherein we give you access to the live practice sessions and also the revision classes. You can enroll for the Oliveboard course by using my20 as the coupon code, which will help you get the 20% discount here. Thank you so much again. And if you have found the video useful, please hit the like button. And if you want to stay updated with respect to the RBI Grade B and SEBI Grade examination preparation, please subscribe to the Oliveboard channel. Thank you so much, everyone.